So in the last couple of days, I've received a few questions roughly in the same genre. They basically revolve around this core topic of whether is it possible that Alibaba goes back to $300 per share. So I'm not too sure why there is this sudden renewed interest, but I think it's a fair question. And it's also important to stress test our assumption and expectations for the business. I'll probably also share my simple framework into understanding their current valuations today. So like any investor, when looking or talking about valuations, the most intuitive thing to do is to look at the next 12-month price target or the price forecast. You want to know how sharks on Wall Street are thinking about the stock itself. But I think for people familiar with the matter, all these forecasts tend to follow the share price in lockstep. I've seen my fair share of Alibaba stock forecasts being re-rated down from 220 to 180 to 150. But I think over the last 4 years at least, the analyst consensus around Alibaba as a company has always been a strong buy. But I think the share price has not reflected that consensus reality. And I think one thing for sure that is definitely a strong buy is smash that like button, because most of you has actually forgotten to smash the button. And the next intuitive thing is to punch in this query into Google search. And we actually do have an article from Zags with the headline, "What's Stopping Alibaba from Getting Back to $300?" Even though it's a slightly dated article in September of 2024, when I tried to superimpose this headline or interest onto the stock chart itself, you can see that in that particular month, that's when you saw that big green candle, and maybe also why people are suddenly interested into understanding whether there's the possibility that we can revisit new highs again. But I think after clicking into the article itself, most, if not all of the discussions are around technical analysis, talking about moving averages, chart patterns, volume analysis, so on and so forth. I want to know specifically how much Alibaba has to grow its top line, what kind of margins does it constitute or justify this $300 per share price target in today's environment. And if you were to rewind the clock and to look at the business foundations or fundamentals, when they were trading at their peak valuation, which was roughly in middle of 2020, actually a few things have changed since then. On the top line, they've printed roughly 550 billion in revenue, 100 billion in operating income, and 130 billion in free cash flow. All these are in the Chinese yuan denomination. And previously, only their core commerce business was operating income positive, while the rest of the other business units are negative. So they had roughly 2.7 billion shares outstanding, and that $300 per share basically translate to roughly a $800 billion valuation. But when looking at Alibaba today, currently in 2025, in the most recent update, they printed roughly 1 trillion in revenue, 140 billion in operating income, and 74 billion in free cash flow. But do keep in mind that they are in their capital reinvestment cycle. In the previous financial year, they printed 156 billion. And more importantly, they've retired roughly 15% of their shares outstanding. So in order for them to hit that same $300 per share, they only have to achieve a 700 billion US dollars valuation. That's quite a fair discount from the $800 billion that we're talking about. I mean, from a share-to-share comparison. Now, when being confronted with these few numbers, I think a few things definitely jump out. Firstly, of course, they are doing a very good job in terms of retiring their shares, especially during the low valuation or lull period of the last 2-3 years. Therefore, I think to hit that same dollar per share, you need a smaller valuation. But I think on the flip side, however, when you really judge the business fundamentals on an objective manner, yes, their revenue did almost double in the 5-year period. But I think the margins have definitely took a hit. Revenue doubled, but I think operating income only increased by 40%, while free cash flow, if you take last year's number, actually increased by a much smaller extent, maybe 20% at best. So from this shrinking in margin, without talking too much about the details, you can probably expect that the revenue that they've added over the last 5 years might be poorer in quality. And I think we have seen after Eddie Wu, the new CEO, taking over, they are stripping out a lot of all these non-core businesses, low margin businesses, and they are saying that they are investing really heavily back into the whole AI and cloud space. I think yes, on one hand, you can say that they have been slightly mismanaged in terms of the reinvestment and getting a return on your capital. But I think on the other hand, when comparing the next 5 years versus the previous 5 years, we can probably expect some meaningful and also sizable change moving forward in terms of the growth rate, the quality of the revenue, and probably also the margins. So I think this is just some food for thought when looking at some of these numbers. So before we go into the specific assumptions, I just wanted to share the latest June promotion from Longbridge Singapore. And fortunately or unfortunately, it's only available to my Singapore audience. So new users to Longbridge today can grab rewards worth up to 800 Singapore dollars. And all you have to do is to create a new account and deposit minimally 2,000 Singapore dollars, and you get to enjoy a 6% per annum interest boost coupon for 90 days. But if you're to sign up with the link below, you get to enjoy an exclusive 18 Singapore dollars cash coupon plus another 6% interest boost coupon. That's totaling up to 12% for 90 days. And more importantly, for the month of June, they actually upsize the bonus for the second tier rewards, where you have to deposit 10,000 Singapore dollars, maintain it for 90 days, and complete 5 buy trades. And from the previous half a share of Apple, now you get 1 full share of Apple, and that's worth $260. But at the very baseline, Longbridge is still extremely competitive with lifetime $0 commission for US, Hong Kong, and Singapore stocks, and also $0 platform fees when you deposit a minimum sum of $2,000. So at the very base tier, if you deposit the said $2,000 and maintain it for 30 days, complete 3 buy trades, you get half an Nvidia share, that 12% interest boost for 90 days, and that $18 partner exclusive. And if you to add up all the new user promotion, that's roughly $163 on a $2,000 deposit. So for those of you who have yet to sign up for Longbridge, I think don't miss out on this crazy promotion. Thank you Longbridge for sponsoring this video. So pivoting back to the topic at hand. So I think from my end, I actually kind of reverse engineered the entire process. And we have to first assume a fair exit multiple. And in this case, I use 20 times price to free cash flow, which also means that you are demanding a 5% free cash flow yield. And when looking at the past, 10-year history, actually Alibaba pre-2020 have been trading at a relatively steep valuation, easily 30 to 40 times. But back then, I think you have to keep the context in mind, where Alibaba was probably one of the very successful tech companies coming out from China, still printing out a crazy amount of growth rates. That's why investors are willing to pay a premium. But I think after that crackdown episode, valuations have also come down significantly. For the better part of the last 2-3 years, they were trading closer to 10 times. But I think as things normalize, as they start to look towards the new growth frontier in cloud and AI, and also while maintaining their core market share, so demanding a 20 times free cash flow over the longer term, I think it's a pretty fair multiple. But that's just my own perspective. And if you're to reverse engineer the process of wanting to achieve $700 billion in market cap, at a 20 times multiple means that you need to achieve 35 billion in free cash flow. But I think we all know that they're currently going through a crazy capex cycle right now. So taking the margins from the trailing 12 month might not be a very accurate representation. But that said, I think to also give you a flavor in terms of what this 35 billion free cash flow mean, judging over the last 10 years. So yes, I understand that over the last 12 months, they only printed 10 billion in free cash flow because they basically tripled or quadrupled their capital expenditure into the cloud infra. And they did give their fair share of warning over the next 3 years that they intend to continue spending at this current rate. But that said, at its peak, they already showed investors that they managed to print 30 billion in free cash flow. So I will let you decide on whether you think 35 billion is building sandcastles in the air. So the next natural question to ask is then, what is a fair free cash flow margin to use for the long term? I think when you look at the past history over the last 5 years, this is the latest trailing 12 month, from the lowest of roughly 7.8% to the highest of 26.5%. So if we were to take some sort of an average, I think if we were to assume a 15% free cash flow margin, I do think that we are on the lower end, but I think to be more conservative, at 15%, you need to generate roughly 230 billion US dollars in the top line revenue. And they're currently doing roughly 1 trillion RMB in revenue. So from 140 to 230 billion, let's take a timeline of roughly 2030, 5 years out, that means that they need to grow around 10.2% compounded annual growth rate in top line revenue. Using a 15% free cash flow margin and a 20 times free cash flow, you then naturally get your $700 billion market cap, which is $300 per share. And this is just to let you have a feel in terms of understanding what are the assumptions needed to hit that mythical $300 per share. Now, what if we use earnings instead? Or in this case, EBIT, which is earnings before interest and tax. Similarly, I think we use a fair multiple of roughly 20 times enterprise value to EBIT. So this also leads to a 5% earnings yield. When looking at the historical past 10 years, they have always traded at 40 to 60 times. Now in the recent 5 years, it's closer to 10, 12 times. At 20 times, I think we go back to 5% earnings yield. Not the high growth stage, but also not at the current depressed valuation. And using enterprise value, you have to net out less cash and add in all the debt. Currently, they sit at a net cash position of roughly $50 billion. And that means you need to achieve roughly a $32.5 billion EBIT. So using the same framework, looking at the past 5 years of EBIT margin of what Alibaba has done, they've roughly ranged from 11.3% to the highs of 15.3%. Average EBIT margin of roughly 13%. You then divide it by the 32.5 billion you need to achieve. So that means they need to achieve roughly 250 billion US dollars in top line revenue. 140 billion to 250 billion in the next 5 years. They need to achieve roughly a 12.6% CAGR in top line growth, 13% EBIT margin, and a 20 times EV to EBIT to hit that 700 billion. So after this reverse engineering process, I hope that you get a better flavor or understanding into what are the different assumptions that goes into play. But I think to also ground you to what Alibaba's core profit and growth engine is going to be in the upcoming 3 to 5 years, I've actually stripped their earnings disclosure and to just focus on the two core arms that we're talking about here. Taobao Tmall and the cloud revenue. So I've basically outlined their revenue over the last 8 quarters. So this is the trailing 2 years. Their growth, their adjusted EBITDA and their EBITDA margin. Yes, I know we are using some of these terms interchangeably. Why just not use EBIT, now use EBITDA? But EBITDA is what they have actually disclosed in their earnings. So that's for proper comparison's sake. I think for long-time investors, a few things definitely comes up repeatedly. Firstly, I think the legacy business, which is the Taobao Tmall e-commerce arm, I think the margins are pretty healthy at 41-42%. They are printing majority of the cash flow for the entire business group. But that said, I think because of their current size and they are defending against competition, they aren't your high grower. You can't expect them to continuously print double-digit growth rates. But instead, I think mid to high single digits, I think still fine. But I think if you look at the cloud side, I think that's the interesting one. You can see this constant margin improvement in the last 4 quarters. Growth rates are slowly accelerating again. And given this entire AI hype cycle, more and more businesses are buying into the idea and they don't want to be left behind. So we are going to probably see some sort of a margin expansion on the cloud front, also coupled with this accelerated growth profile. So we can see that I think cloud is definitely going to take a much bigger representation in terms of the revenue pie at a much higher growth rate and also a better margin moving forward. So this is the story that I tell to match my valuation framework, expecting much better growth rates on Ali Cloud from the next quarter out, even higher than the recent 18% that they've clocked. Even though Ali Cloud is the leading player in China today, I think they've yet to hit scale and we do expect a much longer runway for growth. So when you compare it to their US counterparts like AWS or Microsoft Azure, their margins are closer to 35 to 40%, while Google, still trying to scale up, is closer to 20%. They are currently sitting at an EBITDA margin of 8, 9, 10%. So I know that you always try to apply a China discount, but largely speaking, I think given their current scale and their expected growth ahead, even trending towards a 20% margin is good enough. Because any incremental growth in margins will actually reduce the hurdle into needing to achieve that so-called $700 billion expected valuation. And of course, like I alluded, Eddie Wu actually gave a very bullish outlook in terms of the cloud growth moving ahead. So he said that the surge that you are seeing in demand growth is representative up and closer to what you can expect to see as the regular pace of growth. On top of that, Zhou Cai, who's the chairman of Alibaba, also gave this very bullish outlook on AI. I'm saying that in the next 3 to 5 years, all of our businesses should be driven by AI. And as long as the country is doing well, I think Alibaba will not have a bad time. Now, with that backdrop, I think here's the conclusion. So both from the free cash flow and EBIT multiple perspective, we did did the calculations saying that they need to grow top line by roughly 10 to 12% CAGR in the next 5 years. But I think the projected revenue growth rate in the next 2 years at least for Alibaba Group is around 7 to 8%. But don't forget, I think this 10 to 12% growth is actually based on the assumption that they have a long-term margin of 15% on free cash flow, 13% on EBIT, and a 20 times multiple. So the quote-unquote saving grace is this. So actually top-line growth rate don't have to pull too much of the weight if we actually see meaningful margin expansion. And considering them disposing their non-core assets over the last few quarters and going all in into this whole AI and cloud endeavor, I think we can see a very sizable and meaningful margin improvement soon. I think the hurdle here is just for Taobao and Tmall Group to continue growing at the mid-single digits through their exploration of the different monetization efforts, which actually should be achievable if the GMV keeps pace with the consumption as they defend their existing market share. And more importantly, a lot of the heavy lifting comes from Ali Cloud as they continue to hopefully compound at least 20+%, plus their margin expansion as they achieve scale. I think this is a very viable path ahead for them to easily achieve that $300 per share. So I think the biggest issue that we are seeing here, at least in the last 5 years, is this massive multiples contraction. So are investors willing to pay up for a 5% yield on the seemingly dangerous Chinese asset? And I think this so-called fair multiple will decide whether they can easily achieve the $300 per share or whether they need to go through the trial or test of fire, constantly printing free cash flow and their earnings, doing buybacks, giving out dividends, so as to convince people to pay a fair multiple for the business itself. So feel free to leave in the comment section down below on whether you think it will be a treacherous journey ahead or whether it's an easy buy for Alibaba today. And I'll see you in the next video, but more importantly and hopefully, I'll see you guys on the moon. Goodbye.